JC Peretz here, founder of AllStarCharts.com, and as always, I am joined by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee?
What's up, JC? What'd you do to the markets, man? Last time we talked on this thing, we were looking good, and what, 7 days later, markets are slipping, stocks are slipping. What's happening?
Some stocks look good, some stocks look terrible. Some stocks look really, really, really terrible. Some stocks look really, really, really good. You know, not everything needs to be correlated. I understand that we've been in some markets where that does happen, where everything moves together. This isn't one of those markets. We have longs, we've got shorts. Some stuff's going up, some stuff's going down. And some stuff, my friend, is going sideways. Is it not?
You want to jump right into it? We've been looking at the semis today. We were talking this morning. We were talking about how we wanted to look for some premium selling trades today due to the rising volatility that we're seeing across the market. I mean, we were talking about how VIX this morning was up above 23, I believe, making a new monthly high. Certainly not at crisis levels, but the highest levels we've seen in a month. And when things like that happen, JC, you know that my go-to move is to start looking for premium to sell. And we were looking across all the indices, and you guys, you and Straza came up with the semiconductors, and let's bring up this chart here that we got of semiconductors, and it kind of bears it out what we're seeing there.
Yeah, you know, you were looking at consumer discretionaries, and you're like, what about discretionaries kind of range bound? And I'm like, well, discretionary seem to be in a wider range. Semis seem to be tighter. We've also seen relative strength out of semiconductors, bigger picture. And then you started doing the math, and you're like, all right, semis. So in this particular case, like, we're not necessarily looking for a breakout. In fact, a breakout would actually be a bad thing. We're not necessarily looking for a severe breakdown. A short-term breakdown is fine. All we're really looking for in semis is for the SMH, which is the Semiconductors ETF, to stay between 270 and 320. That's it, right?
Yeah, the bet we're making here and the thought that we have is semis, as you can see on this chart, have been in a pretty tight consolidation since November, with 290 being kind of the lower bounds. Now, that level is being threatened today, and that level might break. But the nice thing is we've got another level below, approximately around 270, that kind of corresponds with some upper resistance. It goes back into the fall. It kind of slides off the left of that chart there. Right. But there's a lot of premium still being offered in the 270 puts when we go out to March options. So 270 puts, and then obviously we're making the bet that semis are probably not going to break out to new all-time highs in the next couple of weeks or next few weeks. That's the bet we're making. That's the bet I'm making. So selling options at the 320 strike above the all-time highs, and then leaning against that 270 level, which feels to me comfortably away. It sets up a good opportunity.
Resistance, right? So, you know, it's not like a random level. It's not like an arbitrary percentage away from current prices. There's a reason that strike is the chosen one.
That's the reason, yeah. And, you know, the premiums are pretty good. I don't know if you have the volatility chart. You probably don't, but the volatility...
Oh, whoa.
Oh, look at you.
Come
Man.
on. What is this?
Walk away, JC. Walk away while you're on top, buddy. Well, okay, so there's the volatility chart, the implied volatility in the SMH options. As you can see, we've been rising steadily since December, mid-December, and we're at the upper range of where we've been all year. And one of the things that we like to do with options, especially when volatility is high, is we like to make the bet that volatility is going to mean revert. It's going to come back down. Volatility is really a play on emotions, right? When emotions are high because they're scared, or they're getting aggressive because of something that they perceive that's going to change the game out there for a stock, people start bidding up the prices of options. But that emotion fades away, that fear fades away, and so that's the bet we're making when we're selling premium, and so that's the bet, right? As long as we stay in that range, one of two things is going to happen, probably both, JC, and that is, if we stay in the range, then the value of an iron condor that we're going to put on is going to slowly lose value as it gets closer to expiration. That's normal. But we'll also be aided by any decrease in volatility. If the volatility comes down, the premiums and all those options are going to start to evaporate even quicker. So either one of those scenarios, potentially both, will help us as a tailwind to make money in this trade. And so we put an iron condor on. You can see the strikes here. We sold, if you look at the red boxes at the bottom there, we sold the 270 puts and the 320 calls. And then we purchased an equal amount of 265 puts on the downside and 325 calls on the upside. $5 away from our short strikes. We collected 215 per one lot unit, right? I mean, I'm showing a 2 lot here, but basically if you did 1 lot, you'd collect 215. The most you could lose is 285. So if the SMH completely breaks up higher into new all-time highs, or if it breaks that 270 low that we had our eyes on, the most that spread could be worth, the most we'll be obligated to buy it back for would be $5. So $5 minus the 215 we collected up front means the most we could theoretically lose or potentially lose is $2.85. Now, that's in a worst case scenario, JC. We're unlikely to experience that for a couple of reasons. The biggest reason being, I don't want to hold this spread all the way to expiration. All right, I have no intention of holding this all the way until options expire in the 3rd week of March. I am either going to take my profit when I could buy this entire spread back for $1. Okay, so I collected 215. I'm going to try to buy it back for $1. And when I can do that, that means that I've collected or I've earned a little bit more than 50% of the maximum gain, right? The most I can walk away with is 215 if I held it to expiration and all the options expired worthless. I don't want to do that. I don't want to tempt the market gods. I don't want to give them more time to take my profit away. So I'll buy it back at $1 when I get the opportunity to. The other way I'll get stopped out of this trade for a loss, potentially a gain, but most likely a loss, would be if SMH trades down below our 270 level right there, or if it trades above the 320 level. I want to see a closing price outside of those levels there. If we see a closing price, that's my signal to get out. It'll most likely be a loss in that situation, depending on the timing. It could potentially be a small win. Either way, I'm out. I'm closing the position. I'm not going to wrestle with it because our thesis for being in is no longer valid. And when our thesis is no longer valid, JC, what do? We get out.
It's the only way to sleep at night, right, Shawnee?
That's exactly right.
Listen, I think it's important to reiterate how the margin requirements change when you sell the wings, right? Or in this case, right?
Well, with an iron condor, what we've done is we've defined our risk, right? So the upside calls and the downside puts that were long define the risks. There is a margin requirement, and the margin requirement is the maximum value of the spread.
But hypothetically, if we were just selling them, right? If you were just short the calls and the puts without buying the $5 on the other side of that, the margin requirements would be much different. That's my point.
Right. It would be significantly higher if we were just naked short the puts and the calls. I don't know the number off the top of my head, but I would imagine it'd be somewhere in the neighborhood of $3,000 to $4,000 to $5,000 to hold a 1 lot if you're naked short 1 put and naked short 1 call. But by defining the risk, the maximum margin that the brokerage will hold is $500 per 1 lot, because that's the most the spread could be worth in either direction because of defining our risk $5 away.
So in this case, we're buying the wings.
Correct. See, you threw me off when you said sell the wings. Then you put me on the wrong path.
Usually we're selling the wings. We're buying the wings in this case. So the bet is very simple. You know, sometimes we're buying breakouts. You know, sometimes we're just buying call options if volatility's cheap. In other cases, we're just betting on a continued lack of trend. And semiconductors have done nothing over the last 3 months. So the expectation is that the mess continues. So just to be clear, it's an SMH iron condor. So it's the March 265, 270, 320, 325. So we are short the 270 puts and the 320 calls, while protecting our position $5 away on both sides, going long the 265 puts and long the 325 calls. And we're doing all of that with the equal amount of contracts for the reasons that we just said. So the bet is semiconductors do nothing. And the longer that semiconductors do nothing, particularly over the next month or so, we'll be able to collect that premium. It's a higher probability of success trade that is not going to make our year, right? Versus like a hero trade that is a low probability outcome of success. But if we're right, it's a grand slam. Like there are those kinds of trades. This is not. This is a higher probability outcome and, you know, not a life-changing win, just a nice win. Right?
Yeah, we're just looking to make some change here, and when a time when the markets are a little sloppy, and that's the beauty of options. We have strategies that can make money in any type of environment. Now, JC, I just want to add one thing to what you said. The bet that we're making, yes, we're making the bet that SMH is going to trade in a sideways range and continue staying in that range, but we're also making the bet that volatility is going to come in a little bit, which will also aid the position.
So that's why they are only semi-scared.
Oh, I see. Yeah, that's exactly what we do there,
Is that
JC.
what it is? Is that what it is? All right. Listen, email us, info@allstarcharts.com. Any questions that you have, follow Sean on Twitter @ChicagoSean. Follow me @AllStarCharts. Any questions, fire it away, or even if you just want to say hello, come say hi. All good.
All right, buddy. Take care, everybody.
Thanks, Johnny. Adios.